Hey everyone, Ben Nelson here. Hope you're doing well. Hope you're enjoying this fantastic weather we're having going into this spring here. We're actually in the middle of spring, but heading into summer here pretty quick. I can't believe we're already in the middle of May, so time flies quickly. Wow. Approaching the halfway mark on the year here. That's a little bit ahead of myself, but anyway, we're moving through the year really quickly here in 2021. So what's going on in the real estate market? Let's take a look. I'll try not to drag this one out as long as the last one. The last one ended up being really long. Just a lot to go over. I'm going to touch on some of those or similar things just to kind of give an update on some of those as well, but I won't spend quite so much time on it. If you would like to chat more about any of that stuff that I don't quite get on all the details, feel free to reach out for any of the resources or to just talk about it. Happy to share those with you. But let's take a look here at just the Portland Market Action Report real quick. I'm going to share my screen and just go over that really quick. Here we go. Perfect. Okay, so we are looking at the April numbers here. So not a whole lot of changes. You can see market is still showing less than a month of inventory. Again, that's Portland Metro as a whole. So, there are segments that are even less than that. There's typically just one of the West Portland areas has more, about 2.5 months. It typically is what's been showing there, and so that's even making it look higher overall than in some areas it's half of a month or right thereabouts. So very, very little inventory, just the same as usual here for the last year or so. New listings increased in April, 42%. Increased 17% versus March. So this is versus April last year. No big surprise there. April, it was very low listing last year because we were right in the middle of COVID shutdowns. So March, April, May listings were way down. And we've been just kind of trying to recover since then because the pent up buyers were there as soon as things opened back up again with showings. Pending sales increased 66%. Versus April last year, and only up about 1% versus March of this year. Again, no surprise there for the same reasons as the new listings. Closed sales increased again a big chunk versus last year for those same reasons, and increased about 15% compared to March. So we are seeing an increase in closings and new listings, which is it's good to see the new listings. Obviously, new listings up about 17% compared to March. Closings are up as well. So we're just not gaining any ground. We're continuing to see, yes, we're getting some new inventory, but there's just getting gobbled up just the same. Market time decreased to 27 days. That is an extremely low average. You can see even when the market was really, pretty good heading into COVID last year, we were, in the mid 40 day on market range. And so this is an average. Most everything that is priced well is a few days on the market, and it could be much quicker if they were responding to offers immediately. But a lot of people, give it over the weekend. So it's a 4 to 5 day average market time for anything that's priced well in a well-located, good condition property. I'm not going to go over a whole lot more here. You can see the trends here. The active residential listings were just really low compared to the prior couple years. New listings, this is again what I was referring to. You could see the huge spike down in April last year. We're back on trend with what we were the year before that, but we're starting with such a low inventory amount to begin with, and the buyers are just, there's the pending sales. It's just we're not seeing an increase in inventory at all. We're just continuing to hold that line of less than a month. And then again, there's the closed sales. Highest, actually didn't see that until right now. Highest closed sales in the last 5 years by quite a bit here in April. And there's your average market time just way down here in the trough. Okay, so that's about it for Portland Metro. I definitely want to hit on some macro things, and I'm going to try to do it here pretty quick so I don't get into too long of a video again here. Let's talk about house prices in general, because again, the big concern is we're in this big bubble again. We're just waiting for the bubble to burst, right? And I'm not going to pull up anything in reference to this right now, this particular part of it. But if you've been paying any attention to lumber prices, commodity prices, the shortage on labor, labor costs going up, there's just a lot going on that is going to continue, in my opinion, to push housing prices up. We've got higher labor costs. We got minimum wages increasing. We've got continued talk of a higher federal minimum wage. If you Google inflation, you're going to see that there's all sorts of concerns about inflation in general. So what does inflation do? It means things cost more. So I don't see a lot. I see a lot that indicates that we are going to have continued upward pressure on pricing. Whether that is value or price is a different question. Your price can go up, but the value as compared to what a dollar is worth could be going down. And if that's a little bit above your head, again, we'd be happy to chat about that. But one of these charts I'll show you will kind of show what I'm talking about with that. So your prices can continue to go up, but the value relative to the dollar can be going down if we're in a highly inflationary economy, which we could be headed into. Again, I'm not going to pull them up, but just Google inflation and go to the news tab, and you'll see all sorts of things with concerns about consumer prices and inflation, which I think I said months ago, with all of this stimulus, all this money they're pumping into the system, I'm not surprised at all. There were some things out there with, we had a dip a while back when things were really slow. And then, so like the high number that came out, I think last month wasn't really high, but I was skeptical about that. And I was really kind of expecting to see more things of what we're seeing today. And we're probably going to see headed forward here, where we're going to see some real inflation, and we're going to continue to see that play out. So let me pull this up real quick here and just kind of show you what I'm talking about with prices relative to value, and then especially when you put inflation into it. So if you look at, I don't think that's the one that I want. There we go. Okay, so this is just the National Home Price Index. So if you look at this, you will see it looks like, oh my goodness, we are, this was the peak back in 2006, 2007, 8, right? Or right before 2008, and then we see the the decline there. And then, oh my gosh, look at how high we are in the, this is the National Home Price Index. So we're way above where we were back here, right? Yeah, that would maybe be some cause for concern if we're right up here. Is there another one of these, following this line? But if you pull this other one up here, look at this one. This one's an interest. So this one has a few different charts on here. This is a inflation adjusted. So this is real house prices. Real house prices. So this is adjusted for inflation. There's a couple different ways. I'll show you one other one because this one makes it look like this isn't a problem at all. Well, not necessarily not at all, but there's another one that shows it relatively on par with where we were back in 2006. But you can see, so this is adjusted for inflation. And you can see we're not even to where we were back at the peak in 2005, 6. We're still way down here relative to adjusted prices, prices adjusted for inflation. So you can't just look at the prices themselves. You have to look at what is the dollar buying you today, and what is the price, what is the value of an asset compared to today compared to what it was back then with what a dollar was worth then. So if you're just taking, well, house price, house is 300,000, not here 300,000, but a house is 300,000 now. It was only 250 or 220 back in 2005, oh my goodness, you have to take that extra step and look at, okay, what would have it been back then if the dollar was worth the same then as it is now. So that's what this is looking at, and you can see that adjusted for inflation, we're not necessarily even where we were before. Now I'm going to show one other one just because it's a little bit. I just got to find it. Sorry. There it is. This is a good resource, by the way. I like this website. Okay, real estate. Here we go. So this is a different one, adjusted for inflation. This is, I'm not going to get too much into this. This is the real monthly principal and interest price index. So this shows with payments and stuff. So this is all really good stuff to look at. This is pretty current. I would encourage you looking at this website here. This is just the CaseShiller index. So this is where it's like, oh my goodness, we're going way back up again in some of these markets, especially. But if you look back here, then so this is the inflation adjusted. So this is the CaseShiller home price index. There's that curve again. We're way up here versus back here. Here's the inflation adjusted one. So this is where I'm saying the other one showed us down here below where we were back then. This one shows about on par, slightly above where we were back then. But it's by far not the out of control number that this makes it look like. When you look at the actual inflation adjusted prices, we're relatively close to where we were back at the last peak. Now, what does that mean going forward? Are we at another peak still? I mean, that's still the peak that we were before. And I would say no. As a general rule, real estate goes up over time. It just does. And I think a lot of people want to point to 2006, the crash, and they just assume that that's where we are today because that's what they experienced then. And we see record high prices, and that has to mean that the bottom's going to fall out, right? I don't think that that's the case. I'm not an economist by any means, but again, just looking at severely low inventory, looking at inflation concerns and inflation starting to become an issue, which if you own real estate, real estate is an excellent hedge for inflation, just with how everything works in assets and asset values and everything. So if you're thinking about investing and trying to hedge against the coming inflation, real estate is an excellent way to do that. We got building costs going up, we got wages going up, we've got all sorts of things that are contributing to what I think is just a continued upward pressure on pricing. I just don't see there being a way where, and again, there could be an adjustment. I mean, a lot of it comes down to financing availability, what's available in the financial world. Can people get loans? How hard is it to get a loan? What are interest rates? Obviously, those play a huge part in what is going on in the housing market. So barring anything huge there, I still think we could even see an uptick in interest rates. And with all of those other pressures, we might see a little blip, but we're not going to see a huge crash. Then you add into the fact that obviously they're very concerned about what happened last time. They meaning like the powers that be, government-backed entities, the Fed, everybody that has power of manipulation over, and yes, I said manipulation, over our economy and over, those trends and how things are moving in the economy. They are very aware that housing is a huge prop to our economy. They know what happened last time. They're going to do whatever they can to make sure that doesn't happen again. And they're being proactive on foreclosures. They're being proactive on trying to make sure that there's funding available, all of the things that really made the problem worse last time. They're trying to make sure that that doesn't happen. Will there be foreclosures? Absolutely. Will there be some issues with people having poor credit and not being able to borrow again? Absolutely. But will it be to the level that it was this last time, 15 years ago now, which is, wow, that was 15 years ago. I don't think that it will be anywhere near that level. And again, I don't want to keep beating a dead horse, but inventory levels, just prices continuing to go up, inflation, all of these things are factors. And again, the proactiveness of all of these things. We don't have the adjustable rate mortgages. We have a really, really huge need for housing, and versus last time we had an oversupply. And so it's just a different storm. There's going to be some things that happen. There's going to be some things that need to work their way out. But to assume it's going to look like it did last time, I think is foolish, because just because something happened a certain way one time, you got to look at all the factors of what's going on right now to see what's going to happen moving forward. So hopefully that helps shed some light on some things. I'm going to share one more thing, and this is with the forbearance side of it, because that obviously could affect inventory levels and that sort of thing. So mortgage forbearance, it's been looking better. The forbearance continues to drop, the number of people in forbearance. I think last time I looked, it was like 3.2 million that were in some sort of forbearance. I would have to look that up again. It looks like now that we estimate there's about 2.2 million in some form of forbearance plan. There is quite a number of people that have worked their way through the forbearance and have been able to make their catch up and make their payments. Again, that's a big difference between this time and last time, is that you could not make payments, but you had to catch it up. Well, and if you're not making your payment, who's going to be able to catch up on 6 months of payments and fees and interest and all that stuff? Probably not very many. Well, when they stack it on the back end and basically give you a loan, give you a year without payments, assuming you can pick your payments back up again when that runs out, you don't have to make all of that back up. So that is going to make a huge difference on the number of people that actually end up going to foreclosure. I believe that a big chunk of these, they're going to continue to be able to figure out some sort of additional ongoing forbearance. I also believe that I'm trying to unshare this now. There we go. I also believe that, it's just a fact. It's not what I believe, that those that do end up going to foreclosure, remember, it's not like we're going to get all of those on inventory tomorrow. Just to be frank, we could use some of those on the market to help with the just the huge pressure on buyers right now, and being 1 of 10, 1 of 20 offers. Some of that inventory would be helpful and bring back some health to the market. Not that I want to, and obviously that's a bad situation for somebody because they're losing their home, but just from a pure, factual standpoint, that would help the market to some degree. Obviously, we don't want all of those on the market at once, but a big chunk of them are going to continue to work things out with their lenders. The ones that do come out, it does take a long time for that to come. It's not like they're all going to come on tomorrow. They're going to come on, 6 months down the road, 6, 9, 12, 18, 24 months. It's going to take time. And then they're going to, be putting them on these asset managers at these banks aren't going to just flood the market with them. They're going to put them on, a little bit at a time. So I don't see that being a huge concern as far as, flooding the market with inventory. I think we still need to continue building. We still need to continue to find ways to bring inventory to the market. And that's going to continue to be a huge need. We're a growing country. We're a growing economy. We have people moving here. We have population increasing. We have a big chunk of millennials that are becoming of age to be buying their first home. So we have a lot of need for housing, and I don't think that's going to change anytime soon. So I'm cutting it off now because I'm still at way less than last time, but getting a little long here on it. So hopefully that helps. Again, I'm happy to chat with you about any of this stuff. If you have any insights that you'd like to share, if you think I'm wrong with something, I'm totally open to opinions. Obviously, this is my take on it. And I, just looking at the same data everybody else is, everybody has kind of their own spin on what they think is going to happen. I definitely don't think the sky is falling. I think we're headed for more of the same here for this foreseeable future, meaning low inventory, rising prices, and that goes back to all of those factors that I talked about earlier. So again, we'd love to be of any help. Feel free to reach out if I can help you with any of your housing needs. If I can talk to you about investing, we invest here locally. We also have some other markets that we invest in that we're working with some investors on. So if you're interested in chatting with me about that and talking a little bit about what we're doing, I would love to do that. Feel free to reach out via Facebook or call or text or message or whatever is easiest for you. Would love to connect and be of any help that I can. Thanks all for watching. Make it a great rest of the day.